What if I told you there are ETFs that pay you every single Friday? Not monthly, not quarterly, but every week like clockwork. Welcome to Dividend Surge, where we surf the waves of American stock wealth. I'm your host, and today we're diving deep into the 5 safest weekly dividend ETFs that can transform your portfolio into a weekly income machine. From ultra-safe Treasury strategies yielding 0.8% to aggressive options, plays delivering 40% plus yields. We're covering the entire spectrum. But here's the kicker. We'll break down exactly what portion of these distributions is real income versus return of capital. Because transparency is everything in this game. Stick around, because by the end of this video, you'll know exactly which weekly dividend strategy matches your risk tolerance and income goals. Let's start with the ultimate safety play, the VanEck BDC Income ETF ticker week. Trading at $20.07 with $4.8 million in assets under management and a rock-bottom 0.4% expense ratio. Here's the genius behind week. Instead of physical ladders, you're building ladders out of Treasury bills. This fund invests exclusively in U.S. Treasury bills maturing in 0 to 3 months, creating what's called a rolling ladder strategy. Picture this. When one T-bill matures this week, they immediately reinvest in a new one maturing in a few weeks. This creates consistent weekly cash flow distributed to you as dividends. The beauty? These are backed by the full faith and credit of the U.S. government. If the U.S. Treasury defaults, we've got bigger problems than our ETF portfolio. With a 0.8% yield, week is perfect for ultra-conservative investors, retirees who cannot afford losses, or anyone parking cash temporarily while earning more than traditional savings accounts. Now let's amp up the income game with ETF number 2, the Texas Capital Government Money Market ETF, ticker MMKT. Trading at $100.20 with $57.6 million in assets and a 0.2% expense ratio. But here's where it gets exciting. A 30-day SEC yield of 4.89%. That's more than 6 times higher than week, while maintaining that government security blanket. Here's how MMKT works its magic. This fund operates like a traditional money market, but as an ETF, investing 99.5% in government securities and repurchase agreements. They follow SEC Rule 2A7 compliance, maintaining a weighted average maturity under 60 days. Think of it as week's more aggressive cousin. Still incredibly safe, but willing to stretch those maturities just a bit to capture higher yields. You're essentially getting a government-backed savings account that pays weekly instead of monthly. Perfect for conservative investors wanting money market returns with weekly liquidity and higher yields than traditional cash alternatives. If you're keeping large amounts in low-yield savings accounts, MMKT could be your upgrade path. Here's where things get fascinating. The Roundhill BRKB Weekly Pay ETF, ticker BRKW. Trading at $45.85 with $4.2 million in assets, 0.99% expense ratio. And here's the kicker. It's essentially Warren Buffett's Berkshire Hathaway with weekly dividends. The fund uses total return swaps to achieve 120.6% exposure to Berkshire Hathaway Class B shares while holding Treasury bills for leverage management. If you invest $1,000, you're getting $1,206 worth of Berkshire exposure. BRKW derives income from Berkshire's performance and covered call premiums, then distributes that weekly instead of Berkshire's traditional approach of never paying dividends. This 1.2x leverage is conservative compared to many leverage products, and Berkshire Hathaway is known for stability. However, with only $4.2 million in assets, this is a relatively small fund, which can mean higher volatility and potential liquidity concerns. Perfect for investors who love Warren Buffett's philosophy but want enhanced returns and regular income. You're getting the world's most famous investor managing your money with a twist. Now we're entering high-yield territory with the YieldMax S&P DTE Covered Call Strategy ETF, ticker SDTY. Trading at $44.84 with $13.45 million in assets, 0.99% expense ratio. And here's where your attention peaks. A distribution rate of 23.69%. Let me explain this zero DTE magic. SDTY uses 0 days to expiration options. Every single trading day, they sell call options on the S&P that expire that exact same day, collecting premiums and distributing that income weekly. It's like running a daily options operation where you collect small premiums from option buyers, making very short-term market bets. But here's the crucial detail you must understand. In their most recent distribution, 51.6% was return of capital and 48.4% was actual income. This means over half of your dividend is actually your own money being returned to you, not investment gains. While that 23.69% yield looks attractive, remember, a significant portion represents capital return rather than pure investment gains. This strategy prioritizes current income over long-term capital appreciation. Finally, the highest yielding option, the Defiance Gold Enhanced Options Income ETF, ticker GLDY. Trading at $17.37 with $4.78 million in assets, 0.99% expense ratio, and an impressive 41.74% distribution rate, the highest on our list. Here's how GLDY creates this substantial income. The fund sells put options on SBDR Gold Trust while holding cash and Treasury bills as collateral. When you sell a put, you're saying, I'll buy this asset at a specific price if it drops, and buyers pay you a premium for that promise. If gold stays above the strike price, GLDY keeps the premium. If gold drops and they get assigned, they own gold, providing inflation protection. This strategy generates income while potentially gaining gold exposure. But here's the critical detail. Approximately 85% of GLDY's distributions are return of capital. The vast majority of your dividend is your own money being returned rather than investment gains. Think of it as a structured way to receive your own money back over time while potentially benefiting from options premiums and gold price appreciation. Both SDTY and GLDY prioritize current distributions over long-term capital appreciation. Before you rush to buy, let's talk risks, because higher yields usually mean higher risks. WEEK and MMKT offer maximum safety with government backing, but lower yields. BRKW adds leverage risk despite Berkshire stability. SDTY and GLDY employ complex option strategies where significant portions of distributions are return of capital, not investment gains. This means you're partially receiving your own money back rather than earning pure income. Several of these funds have relatively small asset bases. BRKW at $4.2 million, GLDY at $4.78 million. Smaller funds can experience higher volatility and potential liquidity issues during market stress. Consider tax implications too. Return of capital distributions reduce your cost basis and may create taxable events when you sell. Always consult your tax advisor about the implications for your specific situation. So how do you build a weekly dividend portfolio? Consider this strategic approach. Start with 40% in ultra-safe options like WEEK and MMKT for your foundation. Add 30% in moderate strategies like BRKW for enhanced returns with manageable risk. Reserve 20% for higher yield strategies like SDTY, and limit aggressive plays like GLDY to just 10% of your weekly dividend allocation. This creates a risk ladder that generates weekly income while protecting your capital. With a $100,000 portfolio using this allocation, you could generate approximately $300 to $500 per month in weekly distributions, depending on market conditions and fund performance. That's $3,600 to $6,000 annually in regular weekly income. Remember to rebalance quarterly and monitor the return of capital percentages in your higher yielding positions to ensure you're not just receiving your own money back without real growth. There you have it. 5 weekly dividend ETFs ranging from ultra-safe Treasury strategies to aggressive options income plays. The key is matching your risk tolerance with the right strategy. Want maximum safety? Start with WEEK and MMKT. Seeking higher income and understand the mechanics? Consider BRKW, SDTY, and GLDY for more aggressive approaches. But always remember, do your own research and understand what you're buying. The beauty of weekly dividends is seeing your investments work for you every single Friday. It's like getting a paycheck from your portfolio. If this analysis helped you understand weekly dividend ETFs better, smash that like button and subscribe for more Dividend Surge content. What's your favorite weekly dividend strategy? Drop a comment below. Next week, we're analyzing whether small-cap dividend aristocrats are worth the risk in 2025. You won't want to miss that surge. Until then, keep riding those dividend waves. This content is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Remember, this is not financial advice, just educational content to help you make informed decisions.